Hi, good afternoon. I'm Ankita Saxena, and we're talking about the earnings. And we have the individual stock movers that are buzzing on the back of their earnings. And one such counter is Lumax Industries, that's in focus on the back of its earnings. In fact, it has posted its highest ever quarterly revenues for Q3 FY26. And there's a beat coming in as far as PAT and EBITDA is also concerned. And now we're joined by the management, Deepak Jain, who's the chairman of Lumax Industries. Hi, Mr. Jain. Thank you and so much. Thank you for taking the time out and joining us today.
Thank you, Ankita.
Mr. Jain, there is a significant surge in your Q3 revenues on a year-on-year basis. In fact, you have posted the highest ever quarterly revenue for Q3. How sustainable is this high growth rate?
I think this is based on the order book, what the company's been enjoying. Obviously, the GST reduction, which has basically come in very timely in the Q3, that's also helped boost the revenues. We are very bullish going forward. Rather, I think Q4, we should be able to beat the Q3 results as well. And I think the order book which we have currently is almost about 1,800 crores, in which about 90% of the order book will be executed in the next 2 financial years. So in that way, we're pretty bullish about the sustained performance of the company.
Right. Also, the company has indicated a revenue growth of 20% for FY27. What are the key drivers and factors that will ensure that this guidance is met?
Well, I think there are 3 aspects of it. One, of course, is the market growth. We're expecting the market to grow about somewhere between 7 to 8%. The second is, of course, the wallet share. The company does expect to expand the wallet share, particularly two-wheeler areas in Yamaha, Suzuki, TVS. I just mentioned the 1,800 crore order book. Of the 1,800 crore order book, almost 60% of the order book will be actually in FY27. This year, this financial year also, we have actually gotten 750 crores of the 1,800 crore order book. So lighting is such a business that you keep on developing orders for the customer and booking orders. And I think last is the value growth, which is coming because of the advent of technology. The LEDs penetration is increasing. Currently, the company does get almost about 65 or 60% of its revenues from LEDs. 40% non-LEDs, and two-wheelers is actually having 80% of the revenues coming for LEDs. So I think with both value creation, the technology growth, the growth in the market itself, we are actually confident that we will be able to sustain this performance of 20% plus in the next financial year as well.
Right. Also, the company has revised its capex plan to 350 to 400 odd crores for FY26. What will be the key segments for deploying this additional capex?
So I think the capex plans, what we have done is we usually do about 250 crores, but I think the company's guidance is within a period of 2 years, we will be about 500 crores, where 350 to 400 will be in this financial year. And about next financial year will be about 100 to 150 crores. Obviously, the capex is in line with the order book, what we have received. The current top 3 customers for the company is Maruti Suzuki, Mahindra, HMSI. And I think all these 3 customers, the company has received good orders. And we would be basically fine-tuning our brownfield projects to ensure that the capex is in pipeline to meet the sustained demand of the customers.
Right. Also, Mr. Jain, the current order book segmentation is more inclined towards the non-EV segment, which is 91%. With the rising adoption of EVs, what kind of changes can we expect in your segment mix and the margin profiles?
Fortunately for the company, it's in lighting business, and lighting is EV agnostic. However, a very clear trend is that with EVs, the lighting technology curve is accelerating. Currently, if you see the revenue from the EV is just about close to 5%. However, in the order book, the EV is about 10%. As EV adoption is getting more and more penetrated in the pass cars and two-wheelers, we'll continue to see the technology curve in lighting going up, and hence more LEDs, more advanced driving beams, more projector lamps. And with this, I think the wallet share and the value share and the content per vehicle will keep on increasing.
Also, Mr. Jain, of the 1,700 crore worth of order book, with 60% entering production in FY27, what is the expected quarterly ramp-up trajectory, and how should we think about the revenue recognition timing?
So I think, as I said, next year it would be about 20%. The company would be doing about close to 4,000 crore plus in this financial year itself, we probably would basically getting that about 5,000 plus, or maybe a bit more in maybe next year. So I think if you look at it from a accelerated growth, I think we are definitely beating the market. Also, the company or the, let's say, market is expected to grow at about 7 to 8%. So given the technology curve and the order book, we probably are expecting to grow double than what the market is expecting.
Right. So, Mr. Jain, since the new products are expected to drive 50% of the 20+% FY27 growth, what are the margins on these new products? Is it higher, similar, or dilutive versus the existing portfolio?
So I think if I come to margins, I think the company has had inched itself to a double digit. I think we would like to sustain this double-digit EBITDA margin going forward. Obviously, with localization coming in and value creation, hopefully in about 2 to 3 years, we should have another increase of about 200 to 300 bips. But then again, this is based on a lot more of the development programs which comes through the tech absorption and the localization plan itself. But I think the company is well positioned to at least sustain the double-digit margins continue and also trying to grow and through cost-efficient measures to actually sustain and grow the margins.
Right, Mr. Jain, on that note, thank you so much for taking the time out and joining us on Earnings with ET Now. We'll let you go on that note, and it's time for us to slip into a short break. Don't go anywhere. We're coming back with lots more on the other side. Stay tuned.